Mr. M.S. Krishnan, Managing Director of Thermax, joins us live from Pune. Mr. Krishnan, morning. This is Nikunj Dalmia from the Mumbai studio. If I look at your numbers, sales are down 5%, profits are flat, EBITDA margins are flat, and margins have declined from 11.1% to 10.6%. Environment is tough, but I'm sure you're not happy with these numbers.
Considering what has happened in the market for the last year, you take it for the full year, I think our revenues are up by 9% and the profits are up by 6%. So, Nikunj, it's not a very bad result. I would rather be a little more concerned about the order booking and order carry forward. Considering that the capital goods industry was undergoing a major difficulty for almost 1 year now, we've been able to churn out something which is better than many in the country. But going forward, our ability to be sustaining a similar kind of a result for the next year is a difficulty based on the order carry forward. We've done a lot of exercises related to market expansion. If you look at it, our international business for the full year is better than previous year. And the normal reporting is done including the deemed export. The physical export, if you go to look at it, is the first time in the history of the company we crossed the 1,000 crore sales in the international market. So that's something which had been effectively putting on the board, becoming very active in Africa, in Middle East and Southeast Asia. And in fact, of the total business that we've done outside India, 15% has come from Africa, and I'm expecting things to be improving over there. Domestic market going forward, I'm not expecting any substantial improvement to be happening with all the difficulties that the power sector is facing. No expansions are happening, and no large ticket size power plants are coming in for captive also. So we will have some difficulty. Silver lining is that water business is growing. Chemical business of the company is growing, service business of the company is growing. But none of this can offset the larger numbers that you would normally get from very large orders in the power sector or captive power. That's the outlook that I'm possibly looking forward to. So tough year ahead. Not very unhappy. In the circumstances that we are in, we have been able to contain our costs. When you have this kind of difficulties and dollar appreciating, rupee depreciating, imported components coming at maybe 20% more than what it used to be costing a year back, we've been still able to deliver a double-digit profit, which is a worry of the market. So I would personally believe the market also would take it fairly positive.
The other point of concern is that the energy segment, which is your mainstay, has seen a degrowth of about 7% over the last year. What can you suggest to say about how the segment will grow in FY13?
Thankfully, in energy segment, we are into heating, cooling and power. Heating and cooling will continue to be growing, but those are not very large and chunky in size. So power is the one which is chunky in size, which is not going to be growing in the next year. So there will be some tough year ahead. Will I be able to compensate with the heating and cooling growth on the top lines? Certainly no. But they are better contributors to the bottom line, because power industry doesn't give you the kind of margins that one would expect. But heating and cooling are a very, very niche kind of business for the company. Succor for the organization is to look at outside India for the next year. Not that things are hunky-dory happening in the captive markets that we are in outside India, but there we have a marginal market share. So our ability to improve the market share outside India will be better in comparison to India, because if I were to take more orders in India, my margins will come down. So I necessarily have to be looking outside India for at least 2 to 3 years till such time we stabilize in India.
So what would be your order forecast, order inflow forecast essentially from the domestic market and also from the overseas market? If you could support that with numbers on how much inflow do you expect, and will foreign orders spell more good news?
I do expect us to be performing better than the current year in terms of order booking for the next year. Because the numbers have come down in the current year, and I would expect a lot of activities happen, and I've got pre-qualifications for plans outside India also and within the country. I don't think any further deterioration can happen in the country. We've seen the nadir, so we should be looking forward to betterment in the domestic market as well as in the international market. I normally will not give a guidance in terms of percentage, but certainly as a management we're looking forward to an improvement in the order booking and carry forward by the end of the current year.
So for the quarter gone by, in absolute numbers, and since this is not a guidance, we're only looking at what you did for the quarter gone by, did you get any fresh orders?
We had 809 crore worth of orders. If I were to compare that with the previous quarter, that is a Q3 we ended up at a 590 crore only. So it's an improvement in comparison to the previous quarter. Now, is the hockey stick going vertical upwards? I am quite positive, because even the month of April, which has already gone by, the booking had not been bad. So I would believe that I should be able to better my performance in the Q1 in comparison to the Q4 of last year also. But these are all islands of excellence. It's nothing like, generic for the entire capital goods industry. You're going to be seeing a recovery in the current year. I don't think the capital goods industry will see a major recovery. Thermax will certainly post a better order book position, but maybe a decline in the top line and bottom line in the coming year.
So let me blend two questions into one. The decline in rupee, is this a blessing in disguise for you because suddenly you are more competitive against China? B, at a time when the order book environment is tough, who has the pricing power?
Well, let me tell you, it is a positive since I'm a net exporter in comparison to the total imports that we do make. So I have a better competitive positioning available in the global markets, certainly with China, because we do compete with China and Korea. So I have that advantage available, point number one. But this is also going to put a pressure on the margins on account of the fact that a lot of raw materials related to secondary level is imported into the country. And at a strengthening prices, strengthening dollar, the domestic manufacturers of commodities like steel, copper, all of them are going to be strengthening the prices too. And I don't have an option but to buy from India. I can't afford to import because rupees very, very diluted to 53. I'm expecting it to go to something like maybe 56 by the middle of the year. So on one side, I have an opportunity available to export more. And on the other side, my costs are going to be going up. Balancing this is going to be a tough game for the current year, but we're good at that. Possibly, I should be able to retain the margin despite whatever could be the market vagaries.